you trying to figure out which accounts to withdraw from or take income from first in retirement, such as your IRA, your Roth IRA, your brokerage account, or your bank account? Well, check out this awesome video about how to do just that. So folks, the way it's thought about in the world is we're supposed to kind of spend money in certain ways in retirement. It's called conventional financial wisdom, and I don't think it worked because what it does is ultimately winds up with most of your money in an IRA account to where every dollar that comes out of your IRA is 100% taxable, all right? So what we typically see is the retirement account is the largest amount of money that people have. In fact, the 401k is going to be your primary vehicle to finance your lifestyle in retirement. And when you retire from your job, you roll your 401k over to an IRA, and that's why you have a large IRA account balance. If you have a pension as well, and you take a lump sum from a pension, you roll that money over to an IRA, and that's also an IRA account balance to where every dollar that comes out of both those accounts is 100% taxable. So if we have a large amount of money inside of these IRAs, all right, and we have a small amount of money inside of a brokerage account and in our bank accounts, what we've done is we've overshot to the tax-infested retirement account side of account structure. And we call this the composition of your accounts, meaning how is your accounts made up? Do you have $1 million and is $300,000 in an IRA, $300,000 in a brokerage account, $200,000 in a Roth IRA, and $100,000 in a savings account? That's your composition of accounts, all right? And so what we typically want to do is start spending money out of the IRAs first. There's a reason for that, folks, is that every dollar that comes out of those IRAs is 100% taxable, but more importantly, as we get through life, when we get to 72, 73, 74, 75 years of age, we start being forced to take distributions out of our accounts in the form of required mandatory distributions, okay? And so what happens here is if we don't spend that money down in the front years, those distributions, those forced distributions get very, very large and cause some major tax problems throughout life, which is why we want to spend some of this IRA money down first. In fact, that's why a lot of people employ something called a Roth IRA conversion strategy in their early years of retirement. They also delay Social Security when they do that. I've got videos on that on the channel as well. Feel free to go check them out. So to that end, what you can do is look at the other side is the outside of retirement account money, is brokerage money, okay? To kind of talk about that is the money you put in the brokerage account, it's already been taxed. So there's no taxes to be paid on that money. And then you've got bank money, okay? One other we have over here that I can put up here, and it really is retirement account money, is also a Roth IRA. So I'll put an IRA up here as well, because that needs to be up here. Super important to have a Roth IRA. But these are your various accounts. And so to me, it's not really about an order of flow, meaning do we spend all of our brokerage account money first, then spend all of our IRA money next, then spend all of our Roth IRA money last, which, by the way, is the order of flow, order of operations for conventional financial wisdom that I don't agree with. And the reason why is I don't want you in a situation to where every dollar that you get in retirement income is going to be taxed, all right? And every dollar that comes out of an IRA is 100% taxable. You put money in over a period of time, the money grew tax-free, and you got a tax deduction when you put that money in, so no tax on the way in, no tax on the growth during the period that you invested the money, and every dollar that comes out is 100% taxable. So what I want to do here, folks, is I want the ability to, when we get to maybe 5 years from retirement, we look at our composition of accounts, go, okay, wait a minute. I've got a very large 401k, very large IRA. I want to build some other money up. I want to build up my Roth IRA savings. I want to build up my brokerage account savings because I want to have some buckets of money to where if I want to draw some money out of, I don't create additional tax liability on my income and my Social Security benefits, all right? So an example is, if I'm looking at myself and I'm starting to bump up from the 12% tax bracket, okay, up to the next bracket, which is 22%, all right, well, how do I stop that from happening? Well, if all of my money is coming out of an IRA, I can't control going from 12% to 22% unless I don't spend that much money. But if I want to spend that much money, if I want to go on a cruise at the end of the year, I want to take my grandkids to Disney World, I want to buy the kids presents, whatever I want to do, I want to be able to do that and not worry about the tax liability, all right? Now, in this scenario right here, if I was starting to bump up on that 12% bracket and I didn't want to go to that 22% bracket, what I could do is if I had some Roth IRA money, I had some brokerage account money, and I had some bank money, I could easily stop the distributions from my IRA and withdraw that additional income out of that Roth IRA, out of that brokerage account, or out of that bank account. And the reason why I could do that is that I already paid tax on those dollars. So folks, you can use account structure as a tool in retirement to really help you mitigate long-term tax liability. And this is an example of doing just that. Another example of doing it is to look at some things like, okay, Ryan, I'm going out of my way to spend money out of my IRA. I want to get that money down. And the reason why I want to do is I want to leave my the reason why I want to do that is I want to leave my kids my brokerage account money and my bank account money and leave them less IRA money. All right. And the reason why you want to do that, folks, is there was a law change about when kids inherit IRAs. And that law change says, well, it used to be like this. When your kids inherited an IRA, they could take a distribution over their life expectancy. All right. Just like you do at RMD. But now the IRS says you've got 10 years to take out the 401k or IRA balance as a kid, okay? So if you're somebody who put your kids through school and they're out doing well in life now, and you kick the bucket and leave them $1 million IRA, they've got to pull out $100,000 a year plus any growth over a 10-year period. That's really going to shoot them up into a higher tax bracket, all right? So if you have these other tools available like the Roth IRA, like the brokerage account, like the bank money, and you spend this IRA down and your kids inherit less IRA money and therefore are able to get more Roth IRA money, more brokerage account money, more bank money, they too will have more tax control and when they inherit the money. And they'll appreciate that, by the way. And to that end, less of your money will go to Uncle Sam and more to your kids, which is why you left the money to the kids in the first place. So folks, again, just think about this. It's not so much about which order we draw from first. We want to use a Roth IRA, a brokerage account, or a bank account as a filler to keep us from bumping up into those higher tax brackets so that we can live life the way we want to and not so much have to worry about taxes. And by having a proper structure of these accounts, you have more control over what tax you pay in your golden years. So really consider about composition of accounts, and start saving some money outside of your 401k when you get to that 5-year before retirement mark, maybe even 10-year before retirement mark. Now, always get the company match, right? So if your company match requires you to put money in and they match you dollar for dollar up to a certain point, always get the free money. But outside of that, consider starting to fund a war chest of bank savings, a war chest of brokerage account savings, and also funding some Roth IRAs so you too can have some tax control in your golden years. I'm Ryan Willis, host of the On the Money YouTube channel and founder of Ally Wealth. Thank you so much for stopping by the channel. If you like the content we're putting out, please give us a like down below. Also the subscribe button as well. We'll keep you updated. We put out awesome content just like this.